If you don't have money, you don't have the right to choose. Having money means you have more choices. Well, the purpose of saving money is not to blame yourself, but to have more choices in the future. If you want to manage your finances, what is the first step? Saving money is to reduce expenses to below income. Some people can't save money even if they earn tens of millions a year because they spend too much. There is also a case mentioned in this book saying that a primary school teacher donated $1 million when he was dying. Why was he able to save so much money despite living frugally all his life? So, you have to learn the joy of saving money. So how can you save money? No matter how much money you have, this advice is valid. The author said to stay away from credit cards and never overdraw your credit card. Many young people now rely on borrowing money every day. Many young people think that there is a minimum repayment amount, so I will pay less and owe a little. The interest rate is very high. Some are 15% and 18%, right? This interest rate is quite high. So there is a mathematical concept here. That is, everyone must establish the concept of compound interest. There is an algorithm for compound interest called the Rule of 72, which is how many years it will take for your interest to double. For example, if you have an annual interest rate of 5%, how many years will it take for your money to double? The calculation is that 5 times x equals 72. If you divide 72 by 5, you will know how many years it will take for your money to double. If you borrow money from a credit card at an interest rate of 18%, then it will double in 4 years. Many people say that compound interest is difficult to achieve. And have you ever seen compound interest achieved? Well, compound interest can be achieved. For example, Washington. If Washington had set aside $1 from his presidential salary, according to the average return of the US stock market over the past 200 years, it would have been about 8% per year. His descendants would have inherited $8 million today. $1 back then could have become $8 million. Some people spend money impulsively. Well, especially in families, there is a way to avoid impulse spending. If you want to buy something, both husband and wife must agree to buy it. If one person disagrees, don't buy it. This is a way to save money. Well, you also need to reflect on yourself frequently. For example, take out the bill for your monthly expenses and look at it to see which items are unnecessary. In my family, I can find that there are many things that I have never used. They are piled up in the attic and disappear, right? You can remember this and not buy this kind of thing again in the future. I don't buy tourist souvenirs when I go out now. I realize that my travel souvenirs at home are unwanted and cheap. When I go out, I spend money carelessly without comparing myself to others. I ask myself if I would buy something if no one else knew about it. People often buy famous brands to show off to others. But if you buy something only you know about, you can determine if it's just vanity. Don't spend extra money just for the sake of showing off. If you say that I am old, right? I started saving money at the age of 20 after listening to this book. What should I do if I still haven't saved money at the age of 40 or 50? The author said that it doesn't matter, just catch up. Any time is the day when you are youngest. Of course, you need to know the effect of compound interest, which means that the younger you start saving money, the more powerful you will be. There is another way to catch up. If you want to catch up with others quickly, it is to postpone retirement. You can postpone retirement because people's life expectancy is getting longer and longer. If you don't save enough money, you may not have enough money to retire. After postponing retirement, your performance on the compound interest table will be better because you will have more years to save money. This is the first concept. I think this is very healthy. It means that everyone should learn to understand the rules of compound interest and let the money keep rolling there. You need to create a long enough pool of blood for yourself, like rolling a snowball. Your pool of blood should be long enough. Then the author finally summarized an investment method. This simple investment method has several rules. The first one is to start saving money as early as possible, right? If you want to manage your finances, you must have money first. Some young people ask, how can I manage my finances if I don't have money? Well, money can be earned by cutting a little bit. And with 300 or 500, you can buy financial products, right? You don't have to have millions to manage your finances. With 300 or 500, you can slowly roll it up. Think about the 72 rules, right? Slowly save up. The second is to save taxes reasonably, which will help you save money. The country has also introduced many tax-saving policies. For example, if you have elderly people to support at home, right? If you have children who need to go to school, and if you buy a house, etc. There are many tax subsidy policies. You need to study more, and every penny of tax that can be saved is worth it. Then the third is to prepare emergency funds. That is, your cash should be at least 6 months of living expenses. Some people are more conservative and even keep a year's living expenses. But if you deposit it in the bank, you must have a guarantee and a relatively safe bank. And the fourth is to be sure to buy insurance. In the past, some believed insurance was not efficient for managing money and preferred to handle their finances themselves, assuming nothing would go wrong. Well, the biggest function of insurance is to protect you in case something goes wrong. For example, as the mainstay of your family, you lose your ability to work. What should you do at this time? You can't achieve that compensation ratio by relying on your financial management, right? So you must have this basic insurance. You should also pay attention when buying insurance. It is to prevent major risks, so you just choose the one with a low rate. The most basic type is enough. You don't need to buy too much because buying too much is useless, and buying too much is duplication, right? If that bad thing really happens, you need to have a guarantee, and you don't need too much else because the financial management efficiency of insurance is not that high after all. Many people like to buy annuity insurance. The advantage of annuity insurance is that after a certain period of time, you will be paid a fixed amount of money every year. The disadvantage is that it is difficult to beat inflation. Then the fifth is a diversification strategy, reduce anxiety, and don't put all your eggs in one basket. Then the sixth is to avoid credit card debt. The seventh is to ignore short-term noise and the market. Don't be up and down in your heart. Eighth, learn to buy index funds. Ninth, choose mainstream products and avoid unusual projects. What are unusual projects? There is a term called alternative investment. Alternative investment is a sector of all investments. For example, venture capital, and investment in Bitcoin and other weird futures and other things. For ordinary people, it is enough for you to understand stocks, bonds, gold, and real estate. If you are not the one who orders the dishes, you may be on the menu, right? So you are likely to be the one who is going to be harvested. Another feature is that you should not participate in anything that can be easily manipulated by others. For example, many people will go and see that there were people speculating on shoes, but many young people don't understand. Speculating on shoes is a very bad financial product because it is easy to hype, easy to hoard, and easy to have a dealer, right? Well, including many emerging investment projects, there are actually huge risks in them, so everyone should stay away from them. And the asset allocation ratio can be adjusted at any time. In fact, when you are in your 20s or 30s, you should have more stocks and fewer bonds. Then, as you get older, the proportion of stocks continues to decrease, and the proportion of bonds continues to increase. After about 60 or 70 years old, the ratio of stocks to bonds is 5.5 or 6.4. It depends on the individual's financial situation and the ability to bear risks. And your mentality, this is also very important. And there is another investment that must not be overlooked. That is, for young people, investing in yourself is very important. You have to preserve and increase your own value. For example, you have to exercise, you have to study, you have to read, you have to get a better diploma, take some valid certificates. This is a process of investing in yourself. Or participating in social activities are actually very important. It is not necessarily right to turn all your money into stocks when you are young. What I said is that investment is really not complicated. It is just about patience and long-term persistence, continuous learning, and improving your own cognition.